Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Hello and welcome to a brand new edition of the State of Economy podcast on the banking and financial services space. Joining me today is Srinath Sridharan, a veteran in the sector and who knows it quite well. He's also an author and a policy thinker. The topic today is also very interesting. It's a follow-up on what the RBI came up earlier this week. The strictures or the heavy restrictions that are going to be placed on relationships that regulated entities have with AIFs. Primarily, is it a move by the Reserve Bank of India to start focusing on this upcoming space called private credit? Is it the first layer of restrictions that the RBI is sort of coming up with to bring some discipline and harmony in how private credit as a segment is going to work from here on? Because private credit funds also deploy the AIF structures. Sometimes it's a part of the asset management subsidiary of banks and other regulated NBFCs and so on. Sometimes they're standalone funds by themselves. When they're standalone, it's not so much a problem. But when it's a part of a regulated entity, that's where the new restrictions are going to come into place. Srinath is here to decode whether this as a move is going to help RBI prevent that process of evergreening, which it says it has found out. Thank you so much once again for joining in at such short notice. But I'm sure you didn't want to miss this one out because this is the topic we've been chatting up about texting for a long time. And in a sense, I would think that maybe yesterday, the circular that came out, RBI is getting a little more cognizant that there is an alternate channel of credit which is flowing in. It's beginning to get noticed by a lot of people in the market. There is a certain kind of an appetite as well for the product. Therefore, perhaps it is now time to look at it more closely from a lending perspective and put in the required strictures. That was my interpretation of yesterday's circular. Srinath, how would you look at it?
Hamsini, first of all, I would concur with what you're saying. And there are two messages that RBI is giving. RBI is saying that if there are any structures which don't come under my regulatory regime, and if you're going to call that as a quasi-credit or a quasi-comfort or a security, I'm worried. That's a clear message, one, because these businesses don't come under, the AIFs don't come under RBI. Two, the other clear message is that unless there is a mark-to-market valuation, which means that the underlying security and the serviceability of those loans, if they are in doubt, and which is the biggest doubt about a lot of these AIF pass-throughs, and the concerns for regulated entities having AIF units in lieu of their existing security, is a worry for RBI. And I think this is one of those rare instances where RBI has called out its worry in the circular, right? It is spoken about evergreening. Generally, It doesn't speak about its worries or concerns. It comes to the point directly.
It's a strong word it used because RBI never comes out using words like evergreening. It's like 100% saying that, yes, that is a practice which I'm able to see in the system. It's scary to an extent.
It is scary, but I think we must read it in context of the continuous supervision of at least the key entities that RBI undertakes, the banks and the large NBFCs. So I'm reading between the lines that there must be something that has happened from last year to now. That's one. Two, they've also not given time for banks to react. They've clearly said in 30 days, I want you to unwind all this. If you don't, I want you to provide for 100% of all this. Not just banks, even the NBFCs. So to me, this is the second time in 1 year, probably 1 year or slightly more, that RBI is sending out a message of parallel structures not acceptable. The previous one was ARC/AIF that banks or NBFCs had comfort with. That was very clear, saying that if you want to transact with them, declare NPAs and provide it on the book and move it on. Two, this time, I think this is far more harsher. If we thought the fintech FLDG was harsher, this is far, far, far harsher.
This is like a big blow.
Yeah, but it'll be interesting, right? Because end of the day, how many of them actually provide for or course correct? Because the quarter will end in the next 12 days. Will they spill it over to the next quarter? What are they going to do? That will be interesting. Some of the banks, large banks, my assumption is, even if they have some of these structures, will try to quickly unwind so that this quarter they get done and dusted and disclose everything. And if it is not rampant, I don't think RBI would have come with a circular. They would have simply told respective REs to take care of it.
But we've had some of the large institutions like Sterling Wilson, Terlite, etc., like the Vedanta Group, etc., just going by news reports wanting to tap the private credit market for reasons best known to them. And these are also big names in the lending sector. So I'm able to see where you're coming from and possibly the concern that the regulator is also trying to address here. But my question is, are these enough to stop evergreening? Because last cycle we saw evergreening in a very different way. Is the private credit route perceived by the regulator as the new model of evergreening? And by forcing the REs to take 100% NPA, 100% provisioning within 30 days, if they're not able to downsell or get rid of that exposure, is it going to bring in cost discipline into the system? I mean, is this enough to be a prohibitive stick for the REs?
So I think REs, progressively this year, RBI has been clamping down, right? I mean, last year it used the inspection report to go back after some of these structures in collusion with ARCs, after all the co-lending and the other packs that they had. Then the RBI has been meeting, expecting the REs to present a lot of these, one as a strategy, two as a granular disclosure to their board. And which is why we've also seen the governor address directors, especially the independent directors of most of these entities over a point in time this year. Right. And this is a very message evidently clear on the wall that any lending activity, there is only one regulator in the country, that's RBI. So I don't know, I'm probably slightly speaking out of turn how this is going to be interpreted or seen by the AIF regulator, which is SEBI. And I hope that we don't get into that SEBI and IRDA kind of a spat that we had many, many years ago. We are very clear, anything around lending, let it be under RBI. Anything around investments, let it be under SEBI.
Interrupt you here for a minute because I want to take this up as a slightly larger conversation. But before getting into, how RBI is ring-fencing itself on the lending part of it, there is another point which comes into my head. Guys investing in these AIF structures, it's the large family offices, wealthy HNIs. Sometimes some of these are itself subsidiaries or parts of asset management companies created by banks and held by banks and REs themselves. So this is a sector where your traditional retail money is not directly flowing, but very indirectly flowing. And if there is a speed bump, if there is a problem, if people are not able to funds that they were promised, because this is also a high yield segment, so-called, which is the lure for people to look at AIFs lately, then are these people going to be quiet? Would they understand that, it's okay, sometimes you're promised 13, but it can be -3? Are these segments, are these HNI family offices, investors who are capable of understanding that? Because that is a point which has been addressed yet.
See, that's a fair question, Hamsini, but the reality is, depending on the fund, who's raising this fund. Now we have seen large institutional PEs also raising monies, private credit funds as well, right? I mean, you saw Blackstone talking about it. You also have the individual professional fund managers, professionals coming together and saying that they will create their own private credit. So the nature is there is no fixed formula. Because you can't really, I think in today's markets, especially if you're doing a cross-border fund and with the interest rates volatility in many markets, nobody can offer a fixed return here on this. These are deal-by-deal basis and also thematic, right? There are some stressed assets or AIFs which they do it. In private credit, the biggest challenge that seems to be, this is the existential question, right? If they are going to charge and get about a return north of 20 to 22%, why are they in that business, first of all? Are you telling me that the banks are not funding those clients? And that is why the clients are moving from the banks to NBFCs and then saying, okay, I am probably going to private credit market as a lender of last resort. Or is it something, a hybrid variety that we have seen like a mezz financing that private credit comes handy? So I think there are genuine reasons which are possible. But from the outside, the fear seems to be that is there real credit understanding in these businesses? The good thing is from SEBI's perspective, they are expecting risk committees and independent director to be on those boards. Some of those are coming in. The closest and the most well-lit regulated private credit market currently in the region seems to be what MAS does in Singapore. The
Right.
amount of diligence of right from fit and proper to the requirement on the governance side to disclosures is phenomenally high.
Very true. But as you mentioned two interesting points here. One, that private credit funds look at avenues which typically banks cannot fund. Not that they don't want to, but they cannot because of the regulatory constraints. Like, for instance, backing M&A acquisitions or funding a promoter to buy out stakes or just distress funding for that matter. Since private credit comes into picture in these pockets, 10 to 12% ROI may not be possible, they're able to enjoy the high yield that they are. Something that is sustainable, point number one. And if so, do you see private credit as replacing what NBFCs were earlier meant to do? 10 years back, NBFCs were mushroom boom and growing because they were picking up those leads which banks were not very successful with. We saw a whole bunch of wholesale NBFCs as well, structured finance, project finance, and so on.
Yeah, absolutely. I mean, let me kind of do a segue into a different kind of question. Are we saying, or are these borrowers and private credit markets looking at SEBI as a easier quasi-lending regulator than an RBI? That's a fear I have.
I agree with you.
Because if you don't have the credit and the underwriting and the collection capability that RBI structures today allow for, and you're going outside of those boundaries, and you're saying that I'm okay with the fuzziness of it, then are we sufficient with today's risk disclosures? I don't think so. Then probably I'm anticipating at some point soon, SEBI also will come along with regulation to kind of match it, because the reality is it's not as if either or, if either RBI does it or SEBI does it. Today's financial markets are about domino effect.
Correct.
We can't have, we just need one private credit fund or one large AIF saying, I have a bad loan and I'm not able to recover it, and it'll have a cascading effect.
It will. In fact, that brings me to possibly the last segment that I want to very elaborately about. Who's going to take responsibility for these NPAs? Because NCD, when were not being furnished by, let's take the case of even a DHFL here, when there was defaults in NCD, there was literally no recourse for people holding the papers, because it was neither RBI's child nor SEBI was in a position to take the upper hand and say, no, this is how it's going to be resolved. And interestingly, 5 years since that episode, this is a question that we've not found an answer to. So with private credit, the complexity is much larger compared to what was with NCDs. Who's going to really own this child? And how are we going to see if there has to be joint ownership? Would people be willing to do it? I mean, equal parenting is possible in a structure like this.
So in the waterfall mechanism, I'm speculating here. I think the public deposits will carry significantly higher weightage than structures like this. I think it is essentially as a fiduciary custodian of public deposits. The nature of such a deposit is very different from a risk-based investment. You know that it could blow up. And which is why I said earlier that I would assume that SEBI would ask now for granular, proactive communication of risks. Almost like, imagine this like a cigarette packet where 70% of the cover is the ghastly photograph. And I think can these private credit funds and the other AIFs bring about their risk parameters upfront?
Reality that we're looking at, and as much as I haven't interacted with people in the PC market, most of them are investment bankers who've taken on to private credit. They are not risk managers. They are not compliance managers. They are not people who are best equipped to price risk or price a funding requirement itself, which means that if given where RBI is at in terms of its stance for the market, the system will also have to see a different breed of people running it. It cannot be an extension of, let's say, somebody's private equity fund any longer. It needs to be seen and respected and treated differently, wouldn't it?
See, that's true. See, one would expect if you're an RE, let's say a bank or an NBFC, you would have different products for the customers you chose to serve, right? But suddenly, if you look back in the last 10 years of Indian financial players across board, and not necessarily only the large conglomerates, but almost everybody seems to have NBFC, an AIF, arrangement with an ARC, and something else on the side. It's almost like saying, I don't want to create products under my regulated entity, but I would rather have multiple structure, whichever works for me. I will kind of average turn at the holding company level, not necessarily at operating company level. That's a fear.
Seen even in the previous cycle. And this is where recoverability becomes a big deal. I mean, the whole core literally is dependent on the operating entities for cash flow, for assets, for everything. The money is at the whole core, but the money is made elsewhere. The classic problem is getting repeated here, and we've not done anything to address it so far.
So I would think that unless there is a large care in the market, probably it might not become a priority conversation in a FSDC agenda,
Right.
where all the regulators come in and discuss these. But it's an apt conversation for them to say, are there any inter-regulator arbitrage that entities are attempting to do like this one? And I think the sooner they decide on how to tighten this would, I think, solve for a lot of their own supervisory troubles.
That's right. So to that extent, should we agree that what happened yesterday, the circular that shook the market yesterday, is the baby steps, the first steps in the process?
I think so. I think this is probably the second thing that RBI has done a month. The previous one being adjusting the risk weights for unsecured lending.
That's true.
And
That's true.
This is the second. So using their policy, they're able to kind of influence what they're doing.
Perfect. Thank you so much for joining in, sir. It was wonderful to have this conversation with you. For one, you've been not a very rara private credit person. You've always taken a very neutral stand, and we couldn't have had a better time than now to discuss this topic. Thanks once again for joining in, sir.
Pleasure, Hamsini. Talk to you.
And with that, it's a wrap on this edition of the State of Economy podcast. We'll come back to you just very soon on a very interesting topic. Till then, do take care.